When we talk about the cloud, I think there is this underlying assumption that it's just fundamentally weightless.
Right, like it's literal magic.
Exactly. We treat it like magic. You upload a massive architectural rendering, or you run a complex AI query, and the data just sort of vanishes into the ether.
Yeah, processed by some invisible force.
And it comes back with an answer instantly. But the reality, the actual physical reality of the digital world is that it is incredibly heavy. It is deeply physical.
Oh, absolutely.
The cloud is, millions of pounds of steel, hyperdense silicon, and thick bundles of copper wire and fiber optics, all sitting in these massive, highly secured, climate-controlled concrete fortresses.
It's physical real estate. I mean, at the end of the day, that's what it is. And when that physical real estate runs out of space, or more importantly, when it runs out of electrical power to keep those machines running.
Which is happening right now.
Exactly. When that happens, the invisible magic of the cloud hits a very hard, very real brick wall. And we are slamming into that architectural bottleneck at this exact moment in the evolution of tech.
Which brings us to the mission for our deep dive today. Welcome, everyone. We are breaking down the Q1 2026 earnings conference call for Equinix.
Ticker symbol EQIX.
Right. And they are the world's largest digital infrastructure and data center real estate investment trust. Now, usually when you open up a corporate earnings transcript in the real estate or tech infrastructure space, you're just wading through a swamp of Wall Street jargon.
Acronyms, financial metrics, you name it.
Yeah, stuff that completely obscures what the company actually does. So our goal today is to take a very data-forward, actionable approach. We're going to translate that dense corporate tech speak into plain language.
We need to extract the key numbers, uncover the actual physical constraints driving those metrics, and figure out exactly what this means if you are holding this stock.
Or if you're just considering it for your portfolio. Because the narrative buried in this specific transcript, it goes way beyond a landlord renting out space for servers.
Oh, way beyond.
Yeah.
It is the story of the AI revolution colliding with the limitations of the global power grid.
Right.
We are seeing a massive shift towards something called agentic AI, severe physical supply constraints, and this staggering 35% surge in sales activity.
Which really reveals how desperate global enterprises are to secure their digital infrastructure before the lights go out.
Literally.
So let's start by looking at the headline data. I was going through the top line numbers for the first quarter, and the scale is just massive.
It really is.
Equinix reported recurring revenue of $2.3 billion for the quarter, which is up 10% year over year when you adjust for constant currency.
Yep.
And their total revenue, which includes some of the one-off hardware and integration fees, hit $2.4 billion, up 8%. But the number that really caught my eye was the adjusted EBITDA.
The profit engine.
Exactly. It came in at $1.2 billion, pushing their EBITDA margin to 51%. That is a 300 basis point expansion over the prior year.
Which is huge.
Right. I mean, in a heavy capital expenditure business like data centers, extending your margin by 3 full percentage points doesn't just happen by accident. So how much of that is genuine operational discipline versus simply, having the leverage to jack up the rent on existing tenants?
Well, it's really a combination of both, but you have to look at the structural mechanics of their operating model to understand that margin expansion.
Okay, unpack that.
So the new Chief Financial Officer, Olivier Leonetti, he pointed to strict cost discipline and operational leverage. In a data center, your fixed costs like the mortgage on the building, property taxes, basic security.
The stuff that doesn't change month to month.
Right. Those remain relatively flat once the building is operational. So if you can increase the density of the computing power within that exact same physical footprint, or if you can increase the number of fiber optic cross connects between the tenants in that building,
then a disproportionately large chunk of that new revenue just drops straight to the bottom line.
Exactly. It bypasses the fixed costs entirely. That is the definition of operational leverage. And furthermore, because power and space are so incredibly scarce globally right now, they have a very firm pricing environment.
Meaning they don't have to offer deep discounts just to fill their facilities.
Right. They hold the cards.
That makes sense for the operational level, but I think we need to calibrate how we actually measure their bottom line profitability.
Yeah, that's important.
Because if a retail investor is looking at a screener for Equinix, they might look at the traditional EPS, right? Earnings per share. But for real estate investment trust, EPS is a notoriously misleading metric.
Oh, it's terrible for REITs. The gold standard here is AFO, or adjusted funds from operations.
Let's break that down for people who might not track REITs every day. Why is EPS so bad here?
Well, general accounting rules force companies to deduct massive depreciation charges from their earnings. It assumes the building loses value every single year.
Like a car driving off the lot.
Exactly, but commercial real estate usually appreciates or at least holds its value. So AFFO strips out that artificial depreciation. It adjusts for the routine capital expenditures required to keep the lights on, and it gives us the true cash-generating reality of the business.
Okay, so what was the AFO for Q1?
Equinix crossed a very significant threshold on that front. For the first time in the company's entire history, quarterly AFFO surpassed the $1 billion mark.
Wow.
Yeah, growing 11% year over year. On a per-share basis, AFFO came in at $10.79, which is a 10% increase.
So the cash generation is scaling essentially in lockstep with the top-line revenue.
Exactly, which proves that the margin expansion you mentioned earlier, it's translating into actual liquid capital, not just accounting gains.
Okay, so the historical performance is undeniably solid.
Yeah.
But the forward-looking metrics in this transcript, I think that's what really indicates a massive shift in the market.
Oh, for sure. CEO Adair Fox-Martin highlighted that this was the largest quarter of total sales activity in their history.
I saw that. Total sales activity was up more than 35% year over year.
Yeah, it includes $378 million in annualized growth bookings, but the figure that I think is really crazy is the $140 million in pre-selling activity.
I want to push on that because if Equinix is fundamentally a specialized landlord, $140 million in pre-selling, it's basically the equivalent of tenants paying premium rates to reserve an apartment in a building where the concrete foundation hasn't even been poured yet.
That's a perfect analogy.
So what does this level of pre-commitment tell us about the supply and demand dynamics right now? Is it tenant panic?
I think it reveals that enterprise architecture teams are sitting down, doing the math on their future computing needs, looking at the global pipeline of data centers, and realizing they are facing a severe deficit.
Like they see the wall coming.
Right, because it takes years to secure land, negotiate high-voltage grid connections with utility companies, and physically build a data center. Enterprises cannot wait for the building to be finished to sign a lease.
Because if they do, there won't be any space left.
Exactly. They will find zero vacancy. The management team noted that this pre-sales motion provides customers with security for their infrastructure roadmap. And crucially, Equinix is not offering bulk discounts to secure these early commitments.
So no early bird special.
Nope. Customers are paying firm premium prices purely for the guarantee that they will have a place to plug their servers in 2 or 3 years from now.
Okay, if companies are aggressively securing space years in advance, paying full price for buildings that don't exist yet, we have to look at the underlying catalyst driving that demand.
The why behind the numbers.
Exactly, because financial metrics are really just the exhaust pipe of actual business activity. And the catalyst here is the fundamental shift happening in artificial intelligence.
On the call, Fox-Martin provided some really crucial market context regarding how enterprise customers are treating AI. She noted that just last year, conversations were entirely centered around piloting.
Like building isolated sandboxes.
Yeah, exactly. Running limited tests to see if, like, a language model could summarize HR documents or draft an email. But now the tone has completely shifted from piloting to enterprise-wide adoption at scale.
And that shift from the sandbox to the production floor, that's really driven by the transition from AI training to AI inference, right? This feels like a critical distinction that really dictates the physical geography of the internet.
It absolutely dictates it. So when we talk about massive AI supercomputers, we are usually talking about training. Training is this brute force process of feeding a model billions of parameters.
Essentially downloading the entire internet.
Basically, yeah, and letting it learn patterns over months of continuous calculation.
And the geography of training is incredibly flexible, because the model is just taking its time learning, right? It isn't sensitive to latency.
Not at all.
You could build a training facility in the middle of the desert next to a massive solar array, or, I don't know, in a remote Nordic town next to a hydroelectric dam. As long as you have cheap electricity and a fiber cable to eventually extract the trained model, the physical distance from the end user is completely irrelevant.
But inference is the exact opposite. Inference is the application of that trained model in the real world.
The actual doing.
Right. It is the moment a user asks their phone to translate a conversation in real time, or a financial institution uses an algorithm to instantly approve or decline a credit card transaction based on fraud detection.
Live, high high-stakes business decision-making.
Exactly. And because of that, inference is incredibly sensitive to latency. The speed of light literally becomes a limiting factor.
Which is wild to think about.
It is. If the data has to travel from a user in London across an ocean to a server in Virginia and back again, the delay renders the AI useless for real-time applications. Therefore, the computers running the inference must be physically located at the edge of the network.
In dense metropolitan hubs.
Sitting mere milliseconds away from the users and the data sources.
Which brings us to the second major force the CEO mentioned, which is the rise of agentic AI.
Yes. This is fascinating.
We're moving past the conversational interface where, a human prompts a chatbot and waits for a response. An AI agent is a piece of software given a high-level goal and the autonomy to execute multiple sequential tasks across different systems to achieve that goal.
Can you give an example of how that works in practice?
Sure. So instead of asking an AI to draft an email about a supply chain delay, an enterprise deploys an agentic workflow to just manage global logistics, period.
Yeah.
So if a storm shuts down a port in Singapore, the AI agent autonomously detects the weather anomaly.
On its own.
Right. It dips into the company's private inventory database, contacts the supplier's API, reroutes the shipment to an alternative port, updates the financial models in a cloud accounting software, and then alerts the customer. All of this happens instantly, without a human in the loop.
Okay, so consider the architectural complexity required to actually facilitate that workflow.
It's massive.
That single AI agent needs to access the company's private sovereign databases. It needs to communicate with external public clouds. It needs to pull real-time weather telemetry from a third-party provider and cross-reference jurisdictional compliance databases to ensure the rerouted shipment doesn't violate localized trade laws.
It's pulling and pushing data from a dozen different environments simultaneously.
Right. And the CEO pointed out that legacy enterprise architectures simply break under the weight of these workloads. She literally said, this deployment gap is an architecture problem.
Because if you attempt to run highly complex multi-system autonomous agents over the standard public internet, the latency creates massive lag.
The cost of data egress fees skyrocket.
Oh, the fees. And the security risks of exposing sensitive corporate data to the open web just become unacceptable. So Equinix is arguing that this specific deployment gap is their massive competitive moat.
Yes, exactly.
They introduce solutions like the Equinix Distributed AI Hub to solve the physical routing of these agentic workflows. But I want to break down the actual mechanics. How does a distributed AI hub physically function within one of their concrete fortresses?
So it really relies on this concept of neutral private interconnection because, Equinix doesn't just provide a room with power and cooling. They curate a digital ecosystem.
Inside an Equinix facility, you have cages of servers belonging to major cloud providers, financial networks, telecom carriers, and enterprise companies all living together.
Right. And the distributed AI hub allows an enterprise to establish a single private fiber optic cross-connect, literally a dedicated cable running through the ceiling trays of the data center from their private servers directly into the servers of the AI ecosystem.
So instead of routing traffic out to the public internet, navigating dozens of external routers, and then coming back into the cloud provider's network.
The data simply travels a few hundred feet over a secure, dedicated fiber strand.
Okay, I want to play the skeptic here for a second. Because if I have a massive global enterprise looking to deploy agentic AI, the simplest solution seems to be consolidation. Why wouldn't I just migrate all of my data, all of my applications, and all of my computing needs into a single, massive public cloud environment?
Like going all in on one provider.
Right. Hand everything over to Amazon Web Services, Google Cloud, or Microsoft Azure, and just run my AI natively inside their walled garden. Why go through the trouble of maintaining private servers in a neutral hub like Equinix just to cross-connect back into those same clouds?
Well, you are hitting on the central tension of modern IT strategy. The reality is that the largest enterprises in the world are terrified of vendor lock-in, and they're fundamentally multi-cloud by design.
They don't want all their eggs in one basket.
Exactly. If you put 100% of your critical data and AI workflows into a single public cloud provider, you surrender all your leverage. If that provider raises their storage prices by 30% next year, you have absolutely no choice but to pay.
You're trapped.
Furthermore, innovation in the AI space is moving so quickly that the best language model today might be on Google Cloud, but the best model next month might be an open source model running on a specialized GPU provider.
And if you are locked into a single ecosystem, You cannot easily pivot to utilize a competitor's breakthrough technology.
Right. You're stuck with whatever they offer. And beyond the fear of lock-in, there are strict legal and regulatory mandates regarding data sovereignty.
Like healthcare and finance.
Yeah. Many healthcare organizations, financial institutions, government contractors, they possess highly sensitive data that legally cannot be hosted in a multi-tenant public cloud. It must reside on privately owned, physically isolated servers.
And that's where the Equinix value proposition comes in. It allows an enterprise to keep their crown jewel data secured on private servers within their own locked cage.
Yes.
Then, using those private cross-connects, they can plug into AWS for specific machine learning tools, plug into Azure for directory services, and plug into an AI model provider for inference, all without the underlying data ever leaving their localized private control.
It's the best of both worlds. And Equinix is layering automated software over these physical connections too. They highlighted their Fabric Intelligence product on the call.
What does that do?
Because agentic AI workloads are dynamic and unpredictable, managing the network routing manually is basically impossible. Fabric Intelligence is essentially an AI managing the network for the AI.
Whoa.
Yeah. It monitors network performance in real time, automatically adjusts routing configurations, and flags anomalies before they cause a bottleneck.
And because Equinix manages over 500,000 live interconnections across their global footprint, the telemetry data they use to train that Fabric Intelligence creates this compounding structural advantage.
Exactly. That neutrality, the ability to act as the Switzerland of the internet, is acting as a massive gravitational pull for the entire AI industry. The adoption metrics shared by management are staggering.
It's hit those numbers.
They stated that 8 of the top 10 AI model providers, the foundational companies actually building the core large language models, are actively expanding their footprint within Equinix.
Securing 8 out of the top 10 model providers is essentially an ecosystem monopoly. And they also noted that 4 of the top 5 neoclouds are expanding with them.
Right. And for anyone unfamiliar with the infrastructure landscape, we should probably define what a neocloud is.
Good idea.
Unlike the hyperscalers that offer hundreds of different software services and storage solutions, a neocloud like a CoreWeave or a Lambda Labs focuses almost exclusively on providing raw, high-performance GPU compute power for AI workloads.
They are the muscle, whereas the model providers are the brains.
I like that. Muscle and brains. And between the model providers and the neoclouds, they have deployed more than 110 separate network nodes within Equinix recently.
Which creates a compounding magnet effect.
Oh, a massive magnet effect. If the primary AI models and the specialized AI computing power are physically located inside Equinix data centers, the major enterprise customers recognize they must place their own infrastructure in the exact same buildings to achieve those low latency cross connects we just discussed.
And you can see that magnet effect materializing in their interconnection revenue. Because Equinix doesn't just charge rent for the physical space. They charge a recurring fee for every single connection between servers.
Right. The toll booth model.
Exactly. Total interconnection revenue was up 9% year over year. But the software-defined interconnection platform, Equinix Fabric, is the real growth engine. Fabric revenue was up 26%, and Fabric bookings skyrocketed an incredible 70% year over year.
70%. That is 70% growth in the digital glue that holds their entire ecosystem together.
It's wild, and management provided some really specific case studies to illustrate what this localized high-speed architecture enables in the physical world.
They did. Let's look at the pharmaceutical company, Quibbit. They deployed a dedicated GPU cluster directly inside an Equinix data center and utilized direct cloud interconnects to pull massive data sets into their environment without traversing the public internet.
Then what was the outcome there?
The result was a 20-fold reduction in their experimental cycle.
Wait, a 20x acceleration? That changes the entire economic model of drug discovery.
It completely flips it.
Because when you are simulating how complex proteins fold, or how a novel compound interacts with a specific cellular receptor, you are processing petabytes of data. If your compute cluster has to wait even a few extra milliseconds to retrieve the next batch of data from a remote cloud, those delays compound over millions of calculations.
Turning a simulation that should take days into a process that takes months.
Exactly. So by co-locating the data and the compute, Quibbit not only accelerated the discovery phase, but also lowered their overall operational costs by a factor of 5.
We also saw a case study from Gamlin Construction, which is a leading engineering services company in Asia. They are utilizing Equinix's multi-cloud platform to deploy AI-powered robotics and drones on active construction sites.
Drones doing risk assessments, right?
Yeah, analyzing structural integrity and safety compliance in real time.
This perfectly highlights the necessity of edge computing. If a drone is navigating the steel skeleton of a skyscraper, capturing high-definition video and LiDAR sensor data, it cannot send that massive payload across the Pacific Ocean to be processed by a central cloud.
The latency would cause the drone to crash before it even received the navigational adjustment.
Exactly. The inference must happen locally. The video data is beamed to an edge node inside a regional Equinix facility, instantly processed by an AI model, and the instructions are beamed back to the drone in milliseconds. The
final case study management shared introduces the most critical physical challenge facing the industry today. Maersk, the global logistics and shipping giant, selected Equinix as their primary infrastructure partner to digitize their supply chain using high-performance AI workloads in Frankfurt, Germany.
But the really vital detail in this deployment is that it utilizes liquid cooling.
Yes.
This is huge.
This brings us to the raw physics of modern computing. For decades, data centers operated on a very simple thermal dynamic. Servers run on standard microprocessors, and you cool them by pushing massive volumes of chilled air down the aisles between the server racks.
It's basically heavy-duty industrial air conditioning.
Right. But the new generation of AI chips, the massive GPUs from companies like NVIDIA, have a thermal design power, or PDP, that shatters the limits of air cooling.
They are so incredibly dense and they process so much electrical current that they generate a staggering amount of heat in a very small physical space.
And air is simply not a dense enough medium to absorb and remove that level of heat fast enough. Not even close. If you put a rack of modern AI GPUs in a traditional air-cooled data center and run them at full utilization, the chips will rapidly exceed their thermal limits. They will thermally throttle, drastically reducing their performance to survive, or they will sustain permanent physical damage.
They will literally melt.
Yeah, they'll melt. The physics of heat transfer demand a more efficient thermal conductor.
Meaning you literally have to plumb the internet with liquid. You have to run specialized liquid coolants directly to the chips.
Which is wild to think about. Water inside a server rack.
Right. This usually takes the form of direct-to-chip cooling, where the specialized cold plate sits directly on top of the processor, and liquid circulates through microchannels to absorb the heat and carry it away to a heat exchanger. Equinix is aggressively retrofitting their facilities to support this.
They detailed a 50% quarter-over-quarter growth in liquid cooling orders, and they currently have 36 active liquid cooling deployments across their global footprint.
But implementing high-density liquid cooling is not as simple as just installing a few pipes. It requires re-architecting the facility's entire mechanical infrastructure.
Oh, it's a massive undertaking. You need specialized manifolds, secondary fluid loops, and massive external cooling towers. Because these AI workloads require so much power and advanced liquid cooling, the fundamental limiting factor for Equinix growth is not customer demand.
Right. The demand for agentic AI infrastructure is nearly infinite right now.
The absolute bottleneck is supply. It is the physical challenge of securing the land, the high-voltage grid connections, and the mechanical cooling equipment to house these dense deployments.
So if the bottleneck is physical supply, we have to examine how management is navigating their capital expansion to basically build their way out of this constraint. They discussed their Build Bolder program, which is a massive global construction undertaking.
Massive is an understatement. Currently, Equinix has 46 major projects underway spread across 32 different markets.
And more than 70% of this retail expansion capital is focused on their major metropolitan hubs, while the remainder targets strategic emerging markets, heavily concentrated in the Asia-Pacific region.
But the scale of their overall development pipeline is what's difficult to comprehend. They have a massive 3 gigawatts of capacity in their pipeline, comprising land under their direct control and projects in active development.
We really need to contextualize 3 gigawatts because the data center industry throws around power metrics that obscure the reality of the electrical grid.
Yeah, what does 3 gigawatts actually mean?
1 gigawatt of electrical capacity is roughly equivalent to the entire output of a large-scale commercial nuclear reactor.
Wow.
It's enough electricity to power roughly 750,000 standard residential homes. Equinix is actively developing a global pipeline equivalent to 3 nuclear reactors purely to power digital infrastructure.
That is, it perfectly illustrates what analysts are calling the power premium. During the Q&A portion of the earnings call, analysts repeatedly questioned management regarding the severe constraints surrounding dense agentic workloads.
And what was management's response?
It was unambiguous. The availability of commercial power is the single largest constraint in their operating environment globally.
And when the supply of high-voltage power is strictly capped by utility monopolies, and the demand from enterprise AI adoption is compounding quarterly, the landlord gained unprecedented pricing power.
Exactly. Supply and demand.
We see this leverage flowing directly into their operational metrics. Their monthly recurring revenue, or MRR, per cabinet increased by 7% year over year, reaching $2,524.
The average enterprise is paying over $2,500 every single month just for the right to place a single rack of servers in the building. And that's before accounting for the advanced cross-connect fees.
The rising MRR per cabinet is a function of both the firm pricing environment and the increasing density of the deployments, right? Customers are packing significantly more computing power into a single cabinet footprint, drawing more kilowatts per rack.
And Equinix charges a premium for supplying that dense power and the requisite liquid cooling infrastructure.
But pouring concrete and waiting years for utility companies to run high-voltage transmission lines is a very slow path to growth. To meet the immediate demand, Equinix is actively pursuing strategic mergers and acquisitions.
Yeah, in the first quarter, they announced a joint agreement with the Canada Pension Plan Investment Board to acquire a data center operator called atNorth.
The atNorth acquisition is a highly strategic maneuver designed to bypass that traditional construction timeline. atNorth provides Equinix with a massive established foothold in the Nordic region, including critical markets like Copenhagen.
And the Nordics become highly prized real estate for hyperscale computing for 2 very specific reasons: climate and power generation.
Let's start with the climate.
The naturally cold climate provides free cooling for the majority of the year. So instead of running energy-intensive mechanical chillers, operators can simply use the ambient outside air to cool the water circulating through the data centers.
Which dramatically lowers the power usage effectiveness, or PUE, of the facility. Basically, it makes it much cheaper and greener to run.
Exactly. And the second reason is the composition of the Nordic electrical grid. It is overwhelmingly powered by highly sustainable, renewable energy sources like hydroelectric dams and geothermal plants.
And as global enterprises face increasing regulatory pressure to meet ESG mandates, environmental, social, and governance, they desperately want the processing power of AI. But they cannot afford the massive carbon footprint associated with burning natural gas or coal to power those GPUs.
So placing their workloads in the Nordics solves the sustainability equation.
Furthermore, atNorth provides an immediate acceleration to their capacity timeline. The acquisition includes an installed and active development pipeline of approximately 800 megawatts that is expected to come online rapidly over the next year.
And management specifically noted that this transaction is structured to be immediately accretive to AFFO per share upon closing.
Meaning it instantly adds to the bottom line cash flow without a prolonged stabilization period.
Right. It pays off immediately.
But I want to push back on this narrative of uninterrupted global expansion, because the macroeconomic environment is incredibly volatile right now. We are discussing a business that consumes multiple gigawatts of electricity across dozens of countries. What happens if a geopolitical crisis triggers a massive spike in global energy prices?
That's a very fair question.
During the call, there were specific mentions of developments and instability in the Middle East. Isn't a hyperscale energy consumer at severe risk if the price of a barrel of oil or natural gas doubles overnight?
So that macro risk was addressed directly by the new CFO, Olivier Leonetti, when an analyst pressed him on energy exposure. Equinix does not leave their operational costs to the whims of the spot market.
How do they protect themselves?
They employ a very disciplined, sophisticated energy hedging strategy. They utilize forward contracts and power purchase agreements to lock in the price of their electricity years in advance. Leonetti revealed that globally, Equinix is more than 90% hedged on their energy costs for the entirety of 2026.
Wait, 90%? That's remarkable.
Yeah. It means that even if a severe supply shock hits the global energy markets tomorrow, Equinix has already locked in the underlying cost of the electricity they will sell to their tenants.
So their 51% EBITDA margins are structurally insulated from short-term commodity spikes for the rest of the year. That provides incredible visibility into that cash flow.
It really does. And regarding the specific geopolitical risk in the Middle East, management provided necessary context to right-size the concern. Because despite their massive global scale, Equinix's footprint in the Middle East is highly concentrated. They operate only 6 data centers in the region, which collectively account for just 1% of their total global revenues.
At 1% of revenue, the entire region is essentially a rounding error on their consolidated balance sheet.
Exactly. Management confirmed that all facilities in the region remained fully operational, with the primary focus being the safety of their personnel. The only material impact on their forward-looking statements was a timeline delay for a single construction project in Dubai, the DX3 facility, which had its ready-for-service date pushed back due to localized supply chain disruptions.
So the systemic macro risk to the broader enterprise is heavily contained.
Yes.
Now, navigating complex energy hedging, executing multi-billion-dollar joint venture acquisitions, and funding a massive global construction pipeline, all of that requires an incredibly sophisticated capital structure.
Absolutely.
We need to examine the balance sheet, the cost of capital, and the specific metrics that dictate customer stickiness. This brings us back to the philosophy of the new CFO, Olivier Leonetti.
Leonetti is a fascinating hire for a digital real estate company. Prior to joining Equinix in March, he served as the chief financial officer at Eaton, and before that, at Johnson Controls.
And Eaton and Johnson Controls are massive industrial manufacturing conglomerates. They build the heavy electrical switchgear, the industrial uninterrupted power supplies, and the massive mechanical cooling chillers that physically go into building a data center.
Right. As CEO Adair Fox-Martin pointed out, Leonetti transitioned from being the CFO of the industry's critical supply chain to being the CFO of the industry itself.
He understands the raw physical components, the manufacturing lead times, and the capital intensity of the infrastructure from the inside out.
On the earnings call, he laid out a definitive capital allocation strategy. His primary objective is to utilize debt as the central vehicle to fund their ambitious $4 billion growth program, deliberately preserving equity and avoiding the dilution of existing shareholders.
Okay, using debt to fund aggressive growth makes sense in theory, but we are operating in a relatively high interest rate macroeconomic environment. If a company takes on billions in high-yield debt to build data centers, the interest payments can completely devour their cash flow. How can they justify this strategy without severely impacting their AFO margins?
The strategy is viable solely because of the immense strength of the Equinix balance sheet and their investment-grade credit rating. They are currently operating at a net leverage ratio of 3.8x, which is highly conservative for a real estate investment trust with highly predictable recurring cash flows.
And they have a ton of cash on hand too, right?
Yes. They have $3.1 billion in liquid cash and short-term investments. Because their default risk is perceived as virtually non-existent by the credit markets, they can access debt on incredibly favorable terms. During the first quarter, they executed a public offering of $1.5 billion in senior notes at a blended effective interest rate of just 3.1%.
Wow. Securing $1.5 billion of unsecured corporate debt at a blended rate of 3.1% is an absolute masterstroke of corporate finance, especially when the risk-free rate on government treasuries is hovering near that level.
It's essentially free money.
Yeah. If Equinix can borrow capital at 3.1% and deploy that capital to build data centers that generate double-digit cash yields, the spread between their cost of capital and their return on invested capital guarantees massive value creation for the equity holders.
That massive spread is exactly why they avoid issuing new shares. Now, while analyzing the balance sheet and revenue timing, there was a specific accounting anomaly in the Q1 numbers that Leonetti had to address to calm the analysts.
Right, the xScale issue. Let's talk about that.
It involved the timing of a massive wholesale lease at their Hampton xScale facility.
First, let's establish the difference between their core business and xScale. Equinix's traditional model is retail co-location. They take a massive data center and carve it up, renting a few cabinets or a small private cage to hundreds of different enterprise companies within the same building. xScale is their dedicated brand for hyperscale wholesale deployments. They build a massive facility and rent entire data halls, or sometimes the entire building, along with tens of megawatts of power, to a single hyperscale client, usually someone like Microsoft, Amazon, or Google.
Right. And in the previous financial guidance, management projected that a massive lease agreement at the Hampton xScale facility would be signed and executed during the first quarter, which would have recognized a significant chunk of non-recurring revenue up front. However, that lease execution did not materialize in the Q1 results.
And whenever a heavily forecasted hyperscale lease fails to hit the quarterly take, the immediate assumption from the market is that the deal collapsed, or that the hyperscaler walked away to a competitor.
Which is exactly why Leonetti was quick to dispel that notion. He clarified that the deal has not collapsed. Rather, they are nearing execution on, quote, expanded mutually beneficial terms.
Let me translate that from diplomatic corporate phrasing to reality. The hyperscale client realized they actually needed significantly more power and space than they originally negotiated. The deal became vastly larger and more complex, which required delaying the final signatures from Q1 into Q2 to hammer out the expanded footprint.
Exactly. The revenue didn't evaporate. It simply shifted 30 days to the right on the calendar, and it will be recognized in the next reporting period.
And the economics of the expanded deal were already baked into their reiterated full-year guidance, confirming that the delay was purely administrative.
This level of demand and commitment from hyperscalers mirrors the extreme stickiness we see in their retail enterprise business. We really have to look at the churn rate for the quarter.
Yes, churn. For anyone unfamiliar, churn is the metric that measures the percentage of monthly recurring revenue lost due to customers canceling their service or moving to a competitor. What was the exact churn figure for Q1?
They reported a record low churn rate of 1.7%.
A 1.7% churn rate in a highly competitive, capital-intensive B2B market is almost statistically impossible.
It's unheard of.
I know management was conservative on the call, noting that the 1.7% figure benefited from the timing of some delayed cancellations, and they expect the full-year churn metric to normalize back into their historical target range of 2% to 2.5%. But even a normalized churn rate of 2.5% forces us to ask, what physically prevents a chief information officer from looking at Equinix's rising prices, finding a cheaper wholesale data center down the highway, and simply moving their servers to save money?
The friction of leaving is monumental. It comes down to the literal physical complexity of the ecosystem they have wired themselves into. If an enterprise decides to leave an Equinix facility, they don't just unplug a server and load it into a moving truck.
It's not like changing apartments.
No, not at all. They have to physically sever the dozens of private fiber optic cross-connects they have established with their supply chain partners, their payment gateways, and their cloud providers who reside in that same building. They have to re-architect their entire border gateway protocol routing infrastructure. They have to secure new public IP addresses.
The migration introduces a massive risk of catastrophic downtime for their core business operations.
It is the ultimate captive audience. The cost, the engineering complexity, and the operational risk of migrating out of the Equinix ecosystem far outweigh the financial savings of slightly cheaper rent at an isolated facility. Once a company plugs into that interconnected fabric, they are locked into the ecosystem.
Okay, so factoring in that structural stickiness, the massive surge in agentic AI inference demand, the strategic atNorth acquisition, and the delayed xScale revenue, management utilized this call to update their financial guidance for the remainder of 2026. Let's break down the updated guidance. Did they maintain their previous estimates, or did they raise the bar?
Because of the broad-based strength across every operating region, management confidently raised their full-year guidance across all key metrics. They increased their total revenue guidance by $21 million, now projecting top-line growth of 10% to 11% for the year.
Sustaining double-digit top-line growth on a revenue base that exceeds $8 billion annually is incredibly difficult. What about the profitability metrics?
The flow through to the bottom line is even stronger. They raised their adjusted EBITDA guidance by $24 million, signaling strong confidence in their ability to maintain those expanded 51% margins despite rising operational costs and supply chain constraints.
And AFO.
Most importantly, they raised their AFO guidance, the metric that tracks the actual cash generated by the real estate, by $40 million. They are projecting 10% to 12% absolute AFO growth, which equates to a full-year AFO per share growth range of 9% to 11%.
Okay, so we have a business growing its top line at double digits, expanding its profit margins, and growing its per share cash flow at double digits. But realizing that growth requires an immense amount of physical construction, how much capital are they projecting to deploy to build out this 3-gigawatt pipeline?
They updated their capital expenditure, or CapEx, plan for the year. Management now expects to spend approximately $4.1 billion in 2026. That figure lands at the absolute top end of their previously provided guidance range.
Deploying $4.1 billion of capital in a single 12-month period is a monumental logistical undertaking.
It really is, and it is essential to break down how that $4.1 billion is being allocated. Roughly $280 to $300 million is categorized as recurring spend. This is the routine maintenance capital required to replace aging chillers, upgrade security systems, and keep the existing global footprint operational.
To keeping the lights on.
Right. The vast majority of the budget, approximately $3.8 billion, is non-recurring spend allocated entirely to growth initiatives, new facility construction, and expanding capacity in highly constrained markets.
I look at that $3.8 billion growth allocation as the ultimate indicator of market conviction. Commercial real estate is a highly illiquid asset class. If a company pours $1 billion of concrete and installs specialized liquid cooling infrastructure, and the anticipated customer demand fails to materialize, the company is left carrying a massive, depreciating liability on their balance sheet.
It's a huge risk.
So to aggressively deploy capital at this scale across dozens of global markets simultaneously indicates that the management team and their enterprise clients believe this shift toward AI inference is not a speculative hype cycle. They're betting $4 billion in cash that agentic AI represents a durable, multi-decade architectural shift in how human infrastructure operates.
And they are rigorously disciplined regarding the economics of that $4 billion bet. Building high-density, liquid-cooled facilities requires significantly more upfront capital than traditional air-cooled buildings. Despite these elevated construction costs, Leonetti stated on the call that they're still aggressively underwriting these new investments to achieve mid-20% unlevered cash-on-cash returns.
Let's explicitly define that metric for our listeners. An unlevered cash-on-cash return measures the annual pre-tax cash flow generated by the property relative to the total cash invested to build it, assuming no debt was used in the construction.
Right.
So if Equinix invests $100 million in cash to build a new liquid-cooled data center in Frankfurt, a 25% return means that once the facility is fully leased and operational, it will generate roughly $25 million in pure cash flow every single year. The building entirely pays for its own construction in 4 years and then acts as an unencumbered cash-printing asset for the next 2 decades.
The CFO noted that achieving a mid-20s return profile is a highly ambitious target in the current macro environment, but it is a target they consistently materialize quarter after quarter. Because the enterprise demand vastly outstrips the available physical supply, Equinix possesses the leverage to be highly selective about the tenant leases they sign, ensuring they strictly protect their required return thresholds.
We have covered a tremendous amount of ground in this analysis today. We have examined the record-breaking financial metrics, the architectural shift from training to inference, the physical realities of liquid cooling, and the aggressive financial maneuvering of the new CFO. It is time to synthesize this data into an actionable thesis. Based purely on the fundamentals presented in this earnings transcript, what is the ultimate verdict? Are these results a bullish or bearish signal for the underlying business?
Analyzing the convergence of surging demand, highly constrained supply, and disciplined capital execution, the verdict has to be overwhelmingly bullish. There are virtually no visible cracks in the operational armor presented here. The physical constraints of the global power grid, which act as a headwind for the broader tech sector, are actually serving as a massive competitive moat for Equinix, allowing them to dictate terms, raise prices, and expand margins.
Let's distill this into 3 specific actionable takeaways for anyone navigating this sector. Takeaway number 1 is the physical migration of artificial intelligence. We are moving past the initial phase of AI, where hyperscalers trained massive models in isolated remote data centers. The future of the digital economy lies in inference and agentic workflows.
Which we discussed earlier.
Right. These autonomous AI agents require instant access to private enterprise databases, localized compliance checkpoints, and real-time APIs. That architecture demands ultra-low latency, strict data sovereignty, and a neutral interconnection environment. Equinix has positioned itself as the physical crossroads, where the foundational models, the specialized GPU neoclouds, and the legacy enterprise data all converge.
And takeaway number 2 is the reality of unprecedented pricing power. The fundamental limiting factor in the global digital economy today is not silicon or software, it is physical electrical capacity. Because Equinix has proactively secured power agreements and development pipelines globally, they hold an incredibly scarce resource.
The power premium.
Exactly. This scarcity is manifested in their ability to drive monthly recurring revenue per cabinet above $2,500 while simultaneously maintaining a historically low churn rate below 2%. They possess the leverage to systematically raise their prices, and the friction of migration ensures that their enterprise customers will continue to pay the premium.
And takeaway number 3 is their masterclass in capital allocation. In a volatile macroeconomic environment, Equinix is accelerating their top-line growth, expanding their EBITDA margins, and generating record levels of AFO per share. They are bypassing the sluggish construction cycle by executing strategic acquisitions like atNorth to secure sustainable power in the Nordics.
And they are funding that massive $4.1 billion expansion pipeline not by diluting their shareholders, but by leveraging their pristine credit rating to secure billions in debt at a blended rate of 3.1%. The spread between their low cost of capital and their high return on invested capital guarantees long-term value creation.
Translating this into a framework for the market. If an investor currently holds a position in this asset, the underlying thesis has fundamentally evolved. You are no longer holding a traditional real estate company that simply leases floor space and air conditioning. You're holding a highly curated, deeply interconnected digital ecosystem. Equinix has become the physical toll booth for the global AI architecture. As long as the deployment of agentic AI continues to scale, Equinix is positioned to collect a recurring toll on the data traffic.
And for someone who is analyzing the sector and looking for leading indicators, the headline revenue numbers are important, but they are lagging indicators. The critical metric to monitor in subsequent quarters is the growth of their interconnection platform.
Which metric specifically?
Keep your focus on metrics like the Equinix Fabric bookings, which surged 70% this quarter. That software-defined interconnection is the sticky digital glue that binds the ecosystem together. If that interconnection growth remains robust, it confirms that the competitive moat remains impenetrable, regardless of what the broader macroeconomy does.
The physical constraints of the real world are finally asserting their dominance over the theoretical, limitless potential of the cloud.
That's a great way to put it.
I want to leave you with a final, slightly provocative concept to consider as we close this deep dive. We are rapidly entering an era where AI agents will operate with near total autonomy. These systems will execute high-frequency financial trades, dynamically reroute massive global logistics networks, and perform complex medical diagnostic imaging analyses in fractions of a second. But as these digital agents become exponentially smarter and faster, they inevitably collide with the ultimate, unbreakable physical limit of our universe, the speed of light.
It all distills down to latency. The physical time it takes a pulse of light to travel through a glass fiber optic cable from one server rack to another.
In an economy increasingly driven by autonomous AI execution, mere milliseconds will dictate the difference between a successful, highly profitable action and a catastrophic systemic failure. Therefore, as we look to the future, the most valuable real estate of the 21st century will not be the scenic locations where humans choose to live, nor the traditional commercial centers where we currently work. The most prized, fiercely contested, and expensive real estate on Earth will be the highly specific, deeply interconnected, power-dense intersections where our autonomous AI agents reside and where they talk to each other.
It is the physical geography of the digital mind.
We encourage you to look past the illusion of the invisible cloud, to question the physical infrastructure that quietly powers your daily life, and to always explore the heavy, concrete realities behind our increasingly digital world. Thank you for joining us on this deep dive.